The US took a bold and audacious step. They ordered JPMorgan and Bank of America to withdraw from a Chinese IPO, not in New York, but in Hong Kong. So how did Beijing respond? No press conferences, no threats, just silence. And then a sudden, quiet exodus. Billions of dollars invested in American debt were dumped without warning, without headlines, without handshakes, just a cold and calculated withdrawal. But it's not just about a single IPO. What's unfolding now is on a much larger scale. This isn't just a trade spat or a diplomatic conflict. This is a controlled detonation at the very heart of the global financial system. Step by step, deal by deal. Washington thought it was increasing pressure on China, but in doing so, it may have set an irreversible process in motion. Because Beijing doesn't make a fuss, it simply moves the money. And the global economy is changing quietly, but dangerously. So let's take a look at that very IPO in Hong Kong, because that's exactly where this silent financial war began. But before we continue, don't forget to subscribe and turn on notifications so you don't miss how exactly this conflict is changing the entire global economy, step by step. It all started with a single deal, an unremarkable IPO on the Hong Kong Stock Exchange. CATL is a Chinese manufacturer of lithium-ion batteries for electric vehicles and energy storage systems, closely tied to the state's technological innovation program. The numbers were impressive. They planned to raise $1.1 billion. Investors from all over Asia showed interest, and among the underwriters were JPMorgan Chase and Bank of America. But behind the scenes in Washington, warning signals were already sounding. On March 27, 2025, the US National Security Council issued an urgent and confidential warning. In their view, CATL poses a strategic threat. Its lithium-ion batteries could soon begin to be used for China's submarine fleet. And behind the company stood organizations connected to state laboratories. And although the listing was taking place not in the US, but in Hong Kong, that no longer mattered. Within 48 hours, both American banks suddenly pulled out of the deal. The consequences were not long in coming. CATL's valuation dropped by $210 million in just one night. But the main thing was the message the US sent to the entire world. They are ready to apply financial pressure not only on their own territory, but also in foreign markets where American companies operate. At the Center for Security and Emerging Technology at Georgetown University, this was called cross-border capital containment, a new form of pressure in which access to capital becomes a weapon. Now, American companies are being made to understand if you want to stay in the game, follow the flag, not the profit. Supporters of Washington's actions have called this strategic deterrence. They argue that American banks must not be allowed to finance China's technological breakthrough. After all, CATL is not just a battery manufacturer, it is a strategic company that powers the energy of the future, from electric vehicles to defense technologies. But critics have warned that the price may turn out to be too high. America is undermining the competitiveness of its own financial institutions, interfering in private capital flows, and casting doubt on the predictability of its own financial rules. If Wall Street can no longer operate freely in global markets, what will happen to its influence? This was not just a conflict over a single IPO. He said that Hong Kong is no longer a neutral territory. It used to be a bridge between East and West, but now it is increasingly seen as Beijing's financial outpost. And by intervening right there, the US effectively acknowledged that the old rules no longer apply. So what was this? A targeted strike, or a sign of Washington's desperation as it tries to maintain control over a rapidly changing system? One thing is clear, the CATL IPO became more than just a stock offering. It was a line drawn in the sand. And now, the whole world is watching to see who will dare to cross it. Just 72 hours after the CATL IPO was derailed, Chinese state banks and sovereign funds began to massively sell off US government bonds. Quietly, coldly, deliberately. According to Treasury Department data on international capital flows, in just the first quarter of 2025, China reduced its holdings by $78.5 billion. This is the sharpest quarterly reduction since 2016. As of February, the total volume of Chinese investments in American assets, including government bonds, agency securities, corporate debt, and stocks amounted to approximately $1.67 trillion. But now this figure is plummeting rapidly. But this was not a panic reaction. It was a strategic move executed with surgical precision. A. J. Rajan, head of the macroeconomic department at Barclays, called it diversification disguised as diplomacy. In other words, China is not pulling out of fear, but because it is preparing for a world where the dollar will no longer be at the center. But where is this money going then? According to Bloomberg, more and more Chinese capital is being redirected into non-dollar assets, gold, infrastructure bonds from BRICS countries, and debt securities denominated in yuan. Purchases of physical gold by Chinese institutions have soared. Trading volume on the Shanghai Gold Exchange reached a 5-year high in March. At the same time, China is ramping up investments in regional trade corridors and credit mechanisms where transactions are conducted in local currencies other than in dollars. But it's not just what China buys that matters. What's important is what it is building. It is creating an alternative financial system that exists alongside the dollar-based one. Part of this strategy involves large-scale purchases of Japanese government bonds. According to a report by New Research, In the first quarter of 2025, Chinese investments in Japan's 10-year bonds increased by 28%. But why Japan? Because it offers liquidity, stability, and most importantly, a reliable alternative to the dollar. One thing is clear, China is not backing down. It is shifting its position, leaving one system and calmly building another. And even though these moves aren't making front-page headlines, panic has already begun on Wall Street. The Federal Reserve is already feeling the tremors beneath the surface. A decline in demand from foreign investors means higher borrowing costs for the US government. If China continues its sell-off, interest rates will rise not because of inflation, but simply because the largest foreign creditor of the US is no longer participating in the auctions. And this sets off a chain reaction. Rising yields mean more expensive loans, budget tightening, and a blow to the dominance of the dollar. Trust is evaporating, and the asset once considered the safest in the world debt suddenly ceases to be untouchable. What we are witnessing is a cold and quiet separation without loud words or sanctions. It's happening only through Excel spreadsheets and trading platforms. China does not want to crash the system. It is building a new system, one that does not have Washington at its center. This isn't just about China. Other countries are watching closely, drawing conclusions, and some are already following in its footsteps. While Beijing slowly steps aside, Washington is preparing to strike back. Not with tariffs, but with a law that could force American capital to leave hundreds of Chinese companies and upend the balance of financial power in Asia. While China acted quietly, Washington chose a noisy path. In April 2025, the Senate Banking Committee advanced a rare bipartisan bill with a clear message. It's time to sever financial ties with key sectors of China. More than 220 Chinese companies have come under scrutiny, deemed strategically sensitive from defense and AI to biotechnology and telecommunications. But it's not just about national security. This is an attempt to control financial flows. According to Bloomberg Intelligence estimates, these companies account for about $812 billion in American investment. Money invested through index funds, pension savings, private investments, and ADRs, American depository receipts for shares of foreign companies. If the law is passed, major investors from the US will be given only 12 months to withdraw their funds. That means BlackRock, Goldman Sachs, and other giants will have to urgently sell off their assets. The scale of the consequences is enormous. BlackRock alone manages $115 billion in Chinese assets that would fall under this ban. This will hit passive funds especially hard, primarily ETFs that track emerging markets. These funds were not created for political decisions, but now it is precisely politics that dictates their strategy. Analysts are already warning about a possible chain reaction. Forced sales could lead to price distortions in the US and Asian markets. Liquidity will disappear, company valuations will collapse, and Wall Street's influence in the 34 trillion Asian region could vanish overnight. Already, the number of Chinese companies considering voluntary delisting from the New York Stock Exchange and Nasdaq is growing. Not because they want to leave, but because legal uncertainty makes it too risky to stay. And at the center of this whole story lies one important question. Can American capital still compete on a global level if it is so restricted by political boundaries? The US financial system was once renowned for its openness, flexibility, and neutrality. Now, all of that is being sacrificed for the sake of control, and this time, the consequences won't be limited to a single IPO or a quarterly report. They could forever change Wall Street's role in the East. While Washington tries to pull the plug, Asia is already laying a new cable, and the current is flowing through it faster and faster. As Washington ramps up financial pressure, Beijing is laying the groundwork for a far more ambitious project, the creation of an independent financial system in which Wall Street is no longer needed at all. At the beginning of 2025, China's Central Financial Commission allocated $423 billion for the development of domestic financial infrastructure. The funds were directed toward everything from organizing bond issuance and cross-border settlements to fintech platforms capable of competing with Western clearing centers. The goal is simple: to eliminate dependence on American financial networks and build their own networks through which Chinese capital can move freely without dollar restrictions. One of the key steps is to abandon Western rating agencies. By as early as 2026, Chinese regulators plan to completely remove Moody's, Fitch, and S&P from the domestic bond market. In their place, national agencies supported by the China Securities Regulatory Commission will appear, which will assess credit risk according to their own Beijing standards. And this is already working. In just the first quarter of 2025, the Shanghai International Exchange, China's equivalent of Nasdaq, accepted new foreign listings totaling $112 billion. Moreover, among them were not only Chinese companies, but also players from Southeast Asia and the Middle East. Companies that until recently would have gone to New York are now choosing Shanghai. It's not just the infrastructure that's changing, trust is changing as well. China is offering developing countries what the US can no longer provide: access to capital without geopolitical risk, without the threat of sanctions, without sudden delistings. Just money, but under conditions that seem more stable. And China is not alone in this. Banks, regions, and sovereign funds from the Persian Gulf countries are supporting this transition. They are moving stock offerings, bond deals, and listings from New York to new financial centers in Asia. As Daniel Rosen from Rhodium Group noted, Wall Street's withdrawal doesn't slow Beijing down, it accelerates localization. Of course, problems remain. Capital controls, the limited convertibility of the yuan, and a lack of regulatory transparency. These are barriers that have yet to be overcome, but the direction is clear. And with every new offering outside the US, the global system moves further away from dollar dependence. While the US tries to freeze the game, China is quietly creating a new one and more players are joining the table. At the center of this process is the BRICS bloc, which is now becoming not just a political alliance, but also a parallel financial system. In the first quarter of 2025, the BRICS interbank payment system processed cross-border transactions totaling $56 billion, a 320% increase compared to the same period in 2023. These are not just symbolic figures, this is a real move away from SWIFT and the dollar. Most of this dynamic is driven by China, which provides more than 65% of the yuan liquidity for settlements within BRICS. And others are joining the process. In April, Saudi Arabia issued bonds worth $3 billion, fully denominated in yuan. The bonds were oversubscribed 4 times, and among the buyers were investors from India, Brazil, and Egypt. This was an unambiguous signal. To attract capital on the global market, the dollar is no longer a necessity. Meanwhile, according to IMF data, the share of the dollar in global currency reserves has dropped to 57.4%. This is the lowest level in the past 28 years. The dollar still dominates, but now its decline is not temporary, but structural. The message to emerging markets has become clear. You no longer need Wall Street to obtain liquidity or issue sovereign bonds. This is not just diversification, it's an escape plan. Countries are building lifeboats even before the next storm of American sanctions hits. And with every yuan-denominated issuance, with every BRICS transaction bypassing SWIFT, one question is being asked louder and louder. Is the dollar still the global standard, or is it now just one of the options? Wall Street thought it had time, but this game is no longer just about size, it's about speed. While Washington argues China is building, American banks are leaving, and BRICS banks are taking their place. IPO after IPO, bond after bond in yuan, this isn't background noise. It's a shift in financial power, created in silence and carried out through capital. So here's the question. Is the world still following America, or has it already halfway left its orbit? Write in the comments what you think about this, and if you enjoyed this analysis, hit like and subscribe. There's a lot more interesting content ahead. See you in the next video. Bye everyone.